Well guys, 2024 is now officially in the books. One of the more bizarre years in real estate, and well, with Trump taking office in a few weeks, I'm guessing 2025 easily will be just as bizarre, if not more so. For the first time in American history, we changed the way consumers buy and sell real estate last year. We defied economics by having high interest rates, depressed sales volume, with equally low inventory. Yet, prices rose. Today, I'm going to break down what happened last year, what's currently happening, and what to look out for in 2025 moving forward. So stay tuned as I try to attempt to make some sense out of all of this craziness. Let's have a property tour, shall we? And stock market just crashed. Deuces. Now before we break down last year, let's first break down last month's numbers. First out of the gate are last month's sales. Last month we sold 1,491 homes. This was a 21% increase over December of 2023, which sounds good until you realize that December of 2023 was the third worst month of sales in well over an entire decade. From a historical perspective, we typically sell just under 2,300 homes in December. So a more accurate way of depicting the market is that last month's sales were down 35% from the norm. Now, sales down, let's see what effect this had on median home prices. While we were relatively flat this winter, unfortunately prices sagged a bit last month to settle in at $470,000. To be fair though, this tends to happen about 50% of the time in December. While January sales tend to be the worst month of the year, December is never anything to brag about either. Most families are more concerned with the holidays versus going out house hunting. So many of the buyers looking to purchase in November and December are actually bargain hunters. As a result, you tend to notice homes closing below comps during these months as motivated sellers dump their homes in lieu of waiting it out until springtime. So while it's not a great look having the median price come down, it's also not too abnormal. Next, let's check in on inventory levels. We ended the year with 4,824 homes on the market. This also marks 7 straight weeks of declining inventory. Sounds bad, but that's typically what happens this time of year. I had to go all the way back to 2013 to find a December where inventory didn't go down every single week. So again, like median prices, not really much to unpack here. The market simply did what it normally does. Now, last but not least is housing absorption by price range. This illustrates how different price ranges are actually performing. The higher the percentage number, the more competitive that price segment is performing. First up is the majority of our market, homes priced between $250,000 to $500,000. This dropped from 31% down to 28%, meaning the competition in this price range is actually weakening, and only about 1 out of 4 homes in this price range are under contract. Next, we have $500,000 to $750,000. This remains steady at 26%. Let's step it up to $750,000 to $1 million. This actually increased a tad to 23% from 22%. Now let's talk luxury. Homes priced between $1 million and $1.5 million. This decreased 2% from 19 down to 17. Finally, we have the ultra luxury market of over $1.5 million. This dropped from 14% down to 13%. Overall, the market dropped from 27% down to 25%. So even though our inventory has decreased, the homes currently in escrow have decreased at a higher rate. So most likely our January sales will be a couple hundred homes less than what we saw in December. Okay, now let's grab a macro perspective on 2024 real quick before we discuss what's likely to occur this year. Last year we sold just under 20,000 resale homes. Ironically, it was a 2.7% increase over 2023 sales. So basically flat. Historically, we sell about 30,000 homes. So simply put, sales were down about 1/3 from the norm. That's disastrous no matter how you choose to look at it. Price-wise, we ended last year at $470,000, as we just covered earlier. This was a 5% increase over last year, which ended at only just over $447,000. Now, even at 5%, we're beating normal housing appreciation. Nothing to brag about, but considering sales were down so much, that's a huge victory for the market. The real crazy part is that before the pandemic, our median price was exactly $300,000 in January of 2020. Our market has gone up 56.7% in just 5 years. Having said that, we still haven't recovered from our high of $485,000 in May of 22. So even though people are complaining about high prices, technically, we still haven't even recovered from 3 years ago. If we're really being technical here, we actually did hit 485 in July of this year. We just managed to lose 15,000 over the past 5 months. But more on that later. When we look at the inventory levels for last year, we actually rose 34% over 2023. The problem with that rising inventory was that it still left us with only about a 2 to 3 month supply of homes for most of this year. So even though sales were terrible, there just weren't that many homes available either. The lack of inventory is the singular reason that home values didn't absolutely plummet last year. Which brings us into the future. So looking at these trends and what's on the horizon, what can we expect for this year? The short version, I have way more questions than answers myself. Going into last year, I was convinced that rates would break 6%, the market would take off at that point, and we would see 7 to even 10% appreciation. As it turns out, I was both right and wrong at the very same time. By March of last year, we were already up 10.7%. But by July, when we tied our record median price of $485,000, we were only up 7.8%. But since July, we've dropped $15,000 and wound up ending the year only up 5%. Mortgage rates did touch 6% when the Fed started lowering, but only FHA loans were able to reach 5.75%. We did see a little bump when Trump was elected, but once he started talking about tariffs, you saw rates start increasing. For now, this is everything. Mortgage rates are tied to the bond market, specifically the 10-year Treasury yield. Well, at the time of this filming, rates are about to hit a 2-year high there. Not good. The higher bond rates climb, the higher mortgage rates will climb. Obviously, high mortgage rates will kill the housing market. But Trump's a real estate guy, right? Trump is all about the economy and bringing down inflation. So the million-dollar question everyone wants to know is, what will Trump do? Are these threats just posturing to negotiate with Canada and Mexico and China and Greenland and the Panama Canal? How long is this going to take, and what effect will this have on inflation and therefore the Fed rate? Will the Fed even bring rates down now? The Fed thought they had tackled inflation, but now here we are again. So until we have an idea on where mortgage rates are headed, it's really difficult to predict the market behavior. Now, if you believe Elon Musk, he stated that it's going to get worse before it ultimately gets much better. Right now, we're clearly in the worst stage. The question is whether or not this will be sorted out before spring or summer. The market tends to appreciate during the spring and summer months the most. If we're dealing with 7.5 or, God forbid, 8% interest rates in a few months, that clearly won't be good for the market. But Trump also doesn't want to be the president that brought inflation back up again either. So the next few months will be very interesting. I tend to think that the first quarter of the year is likely to be pretty mellow. I would greatly expect prices to remain relatively flat for a while. The keys here are inventory levels and mortgage rates. If we can keep inventory levels at bay, we should be okay. If we can start bringing mortgage rates back down by mid-spring, it's still possible we could see a nice bump again this year. Ultimately, I think this is going to be a big year of settling in. With so much turmoil on the horizon, it's very difficult to attempt to predict anything right now. My gut, however, says this is going to wind up being a relatively flat year in the market. I wouldn't be surprised if prices continue to sag for a few months before ultimately recovering later and winding up the year quite similar to last year. Figure 4 to 6% appreciation. Now, having said that, we've got terrorism attacks already, mysterious drones over the East Coast, multiple wars going on, and big-time trade policies to negotiate. So any one of these issues could send markets spiraling. So buckle up, because 2025 is certainly shaping up to be a wild ride either way. In the meantime, please help by liking this video and subscribing. Till next week, deuces.